Michael Berry of Big Short fame backed a Twitter thread by a financial expert who said that spillovers are currently in action in Chinese markets and may spread quickly worldwide. There are significant losses already for the international holders of China credit and equities, the analyst stated. Uncertainty and volatility will remain elevated. Others predict Beijing will fail to keep its grip. So, according to Shane Oliver, chief economist of Australian bank AMP Capital, Evergrande's scale makes it extremely dangerous. He expects Beijing to interfere, but he's cautious there may be a few big bumps along the way. Soros fund management founder George Soros is likewise worried. He mentioned in an article in the Financial Times that it is over-indebted and in danger of default. This could cause a crash. So, let's take a look at why economists are worried about China's economy and its impact on the rest of the globe. Before we go on, make sure to subscribe to our channel so you receive more of our interesting videos. China cut a key interest rate today as new data indicated that the world's second largest economy is shrinking. The People's Bank of China unexpectedly reduced the medium-term lending rate, via which it gives one-year loans to the banking industry, by 10 basis points to 2.75%, the first reduction since January, highlighting Beijing's worry over falling consumer demand. According to new data released shortly after the central bank's decision, the country's economy barely escaped a drop in the second quarter, as consumer and industry activity halted in the face of recurring pandemic lockdowns. Retail sales and industrial production grew, but far less than expected, while youth unemployment hit a record high of 19.9%. In response to the disappointing numbers, Chinese shares fell, deviating from rising share markets in other key countries such as the United States, and eroding investor confidence in the global outlook. Lower sales of high-end commodities, such as second-hand pricey watches and bags, show dwindling customer trust. Increasing geopolitical concerns are also putting pressure on sectors, such as semiconductor manufacturing, while demand for chips used in cell phones and consumer electronics has decreased. As a result of market sell-offs and significant defaults in the country's ailing property sector, Chinese investors have turned to alternative assets, such as jade, while cash-strapped customers have started a new passion for soon-to-expire foodstuffs. Nonetheless, lockdowns and strict quarantine regulations continue to be the principal drivers of the new pessimism. China is definitely in a very desperate situation, mentioned Jingdong Chen, an economist at BNP Paribas. The problem now is no effective demand. If you don't allow people to come out and consume, there is no demand. In August 2022, China's central bank cut a key interest rate for the second time that year, draining liquidity from the banking industry. Analysts believe the government's policy diversion from other large nations' hike rates is owing to the government's resolve to sustain the struggling economy, according to Reuters. Furthermore, real estate investor Graham Stephen wrote a thread on Twitter in which he addresses, among other things, how Chinese investors are captivated with real estate, investing up to 70% of their money in this industry. So, because the Chinese stock market is untrusted, as seen by the Shanghai Composite's failure to rebound from its 2008 peak despite China's GDP tripling since then, Chinese citizens prefer to invest in real estate. As per Stephen, the median house price in Beijing might be up to 25 times the average annual salary in 2008. Because of the high demand and high prices, developers pre-sold unfinished homes and then used the proceeds to start other projects. The real estate crisis spread to banks financing money for building projects as developers fell behind on payments. Such considerations might lead to China missing its 5.5% GDP growth target, which investors should keep an eye on. As Stephen concludes, Chinese firms have investments in US stocks, and thus economic concerns in China may result in the sale of these assets. Investors need to be aware of several global macro trends, despite the severity of the Chinese real estate crisis. Since economies are indeed fragile as a result of shocks endured during COVID lockdowns, severe stock market sell-offs are possible any time a new external shock hits the markets. The People's Bank of China has granted a US $150 billion bailout for developers who are working on unfinished apartment buildings. A deeper look indicates, though, that authorities are replicating the convoy strategy of bank bailouts introduced by Japan in the 1990s. The central bank is pressuring larger, more solvent organizations to invest in failing developers and community banks. This is an attempt to lessen the damage and bills to the government. Unfortunately, this may not be a practical solution. By pushing good banks to bail out failing small banks overburdened by bad real estate bets, China risks infecting larger institutions with the troubles of the weak. The convoy system impeded lending by Japan's surviving large banks, stifling overall economic expansion. China must avoid creating risk-averse institutions that hoard undesirable assets or, worse, zombie banks and firms that stutter. This picture might begin to play out in China. Instead of simplifying and stabilizing, the convoy tactic may delay recovery and spread the bad repercussions. The Chinese government is also working to keep housing prices from falling. On the surface, this appears to be a fair strategy: minimize the downside, lessen the concerns. Yet, such management may restrict developers from cutting prices to renew excitement, as well as limiting firms' ability to generate funds to complete developments or settle debts. Authorities may be unable to reverse the drop in house values. Because so much is built on this basis, a growing lack of confidence will have major economic ramifications. Property swindles are upsetting. This one will put the Chinese government to the test. Can they deal with the misery and spread it in such a fashion that market signals can perform? At this stage, the economic implications are becoming more severe, regulators are trying to catch up, and policy approaches are inadequate. According to the IMF, China's GDP would contract by 3.3% in 2022, the slowest rate in 40 years, falling well short of the projected 5.5% target. The rest of the globe loses when China's economy shrinks. History has shown that financial crises are typically caused by a housing decline or a stock market disaster, or both. Consider the 1929 stock market crash, which started as a home boom and bust cycle in Florida and grew into a stock market tragedy that shook the United States and the planet. Consider the 2008 global financial crisis, which started with complex derivatives in subprime mortgages and soon moved from bank to bank and market to market as investor panic rose. In 2023, analysts believe that China will experience the latest form of a devastating housing price collapse. It will have a far-reaching effect, undermining other economies and spreading outside. Did you find this video interesting? If so, don't forget to hit the like button, subscribe to the channel, and share your thoughts in the comments.